Welcome to FinStreet. We have with us Mr. Bhise, who tracks banks at JM Financial Institutional Securities. Samir, welcome to the show. Now, to begin with, how would you rate Q3 FY24 performance of the bank? It was on the weaker side with respect to PNL, especially for PSU banks. So, what's your takeaway from the Q3 results?
Hi, thank you, Abhishek. Thank you for having me on the show. So I think generally the sector saw a bit of softness with respect to the PNL. PSU banks, I think primarily it was got to do with the higher wage revision impact that we saw during the quarter. But if you see for private banks, there were continued pressure on margins, which has been a bit of a sore point for some time, and also the newer debate on LDRs, which has been having an impact on stock prices and growth outlook. PSU banks, from that perspective, are relatively better placed. But yes, if one looks purely at a Q3 level, uh, it was impacted due to the higher wage charges as well as continued pressure on deposit costs.
Well, talking about deposits is been the focus point of all the banks, and even in recent conferences, many lenders have sounded caution on deposit growth. What is actually impacting the deposit growth, and why are lenders so worried?
Yeah, so I think it remains a sore point for the sector across. One has to put it in context with the fact that retail deposits are difficult to come by. Also, primary reason could also be that the savings rate overall over the period of time has kind of come off for the economy as a whole. At the same time, there are alternate asset classes which are doing significantly better. And obviously, given the distribution of financial products, which is kind of growing uh, uh, in deeper geographies, that gives the incremental customer more options to kind of move to the better yielding assets. Some of the smaller banks are offering very strong rates on normal savings deposit as well as term deposit, which to a certain extent has to impinge on the larger banks deposit growth. So I think it's a challenge. And at the same time, regulator has indicated that most banks which are above 90% in terms of LDR have to gradually bring it down. So I think that is why you will see continued pressure on deposits for most of these guys.
Well, Samir, just to highlight our viewers, we had broken the story with respect to credit deposit ratio of the banking system coming down to 75% as per RBI guidelines in December. So, to slippages, if you look at that, for some lenders, it's increased, especially on two key segments. One is the MFI portfolio and the other is unsecured retail portfolio. Q4 is always a strong quarter, but Q1 onwards, what do you expect with respect to asset quality for the banking sector?
So I think some bit of normalization of slippages as well as credit costs from the extreme low levels seen in 1H of 24 was due. At the same time, given that unsecured was one of the fastest growing products, and regulator has also acted on it and well in time there. We expect moderation in unsecured growth for the sector as a whole, banks and NBFCs. At the same time, is it worrisome to change the entire credit cost dynamics for FY25? I don't think it is. I don't think it is hitting that kind of a level, especially for the banking system. So once we enter FY25, we expect normalized credit cost for the sector. So we have built in slight increase in credit cost for FY25 versus FY24. Is it a worry that credit costs are going to spike to meaningfully higher levels? I don't think so.
Well, you spoke about unsecured portfolio. It's been one of the drivers of net interest margin. With now seeing the rise in cost of deposit, can we say that best of net interest margin is behind? How do you see the net interest margin trajectory for the banking sector going ahead?
Yeah, I think good question. So first half of FY24, most banks probably saw the peak of their net interest margins. FY25 is kind of a situation where, on one hand, banks or especially the private banks will have to work on normalizing their LDRs, so they need to push for higher deposits. At the same time, if one were to enter a rate decline trajectory by RBI, say probably sometime second half of next year, or early CY25, you will have assets repricing immediately. So we do not expect meaningful inch up in margins. In fact, we expect a tight range with slight pressure on the lower side in FY25 for the sector as a whole. I think liquidity improvement will be critical for sector to kind of see a reprieve from the margin pressures that we are seeing currently.
Well, liquidity is the hard work that banking sector is facing right now. Samir, with respect to valuations, we have seen valuation expansion for PSU banks while largely static to a bit of decline for private banks. What is your view with respect to valuations for the banking sector, both for PSU banks and private sector banks?
Yeah, so I think private banks have derated quite a bit, and obviously some of these factors that we have spoken for last few minutes are important, and that is driving valuations. PSU banks, I think, continue to benefit from the strong macro. Plus, they don't have the issues such as LDR hitting higher levels. So I think if macro remains okay, and we don't have a runaway worry on credit costs, nor do we have a substantial decline in rates, PSU banks might outperform in the near to medium term. Once we have a meaningful change in the interest rate trajectory from the regulator, that is when I think private banks could be slightly better placed.
Your top picks, final question?
Yeah, so we like ICICI, we like Axis and IndusInd among privates. Canara BOB remained our preferred place. Canara BOB and SBI are preferred place in PSUs.
Well, that's a word coming in from Samir Bhise of JM Financial Institution with respect to Q3 FY24 performance of the banking sector and the outlook for banking sector going ahead.